Throughput accounting allows companies to identify where they're constrained and then help them make decisions about how to maximize sales and profits. Sound too good to be true? It kinda is, but at the same time it kinda isn't. You see, it's very hard, complicated, and not easy to grasp on your first attempt. But once you do understand throughput accounting, you'll be able to make great business decisions. To summarize, throughput accounting has 5 main steps. First of all, you have to find out where you're constrained. This is also called a bottleneck. Second of all, you have to calculate what's called throughput profit per product. We'll dive into what that means here in a minute. Third, you want to decide how much throughput profit there is per bottleneck resource. That's a lot of vocabulary words, but don't worry, we're going to show you a great example about how to do all this in just one moment. Fourth, you have to actually prioritize which products have the highest amount of profit per bottleneck resource. And then fifth, you have to calculate your future investment and production plan in order for you to maximize sales and profits. With no further ado, let's dive into throughput accounting. To identify your bottlenecks, you have to be able to really understand your product, the demand for your product, and the process it takes to create your product. So let's use a great example. Let's say that we run a beer manufacturing company. We make 3 different types of beers, and every beer goes through the same process. Each beer is mixed, fermented, and then bottled. Each batch of beer takes about 3 days to mix, 20 days to ferment, and 5 days to bottle. And each batch of beer is around 10 total bottles of beer. Now our goal is to sell 100 beers this next month. What's our bottleneck? Without doing the math that throughput accounting teaches us, it's pretty tough to say what's going to be our bottleneck. So let's go through the math that throughput accounting is really based on. The first step in throughput accounting math is finding out how many total batches you can make in each of the process. So for example, let's look at mixing first. As we said, mixing takes 3 days. Now we have 30 days in a traditional month, and so we can make a total of 10 batches. That's just 30 days divided by the 3 days of mixing, 10 total batches. And we said earlier that there's 10 beers per batch. So that means a total of 100 beers, hitting exactly our goal. So if we know that mixing will allow us to meet our goal, that doesn't seem to be the bottleneck. Let's go to the next step, which is fermenting. Fermenting takes 20 days to do a single batch. Now in your traditional month of 30 days, it only gives you 1.5 batches of beer, which is only 15 total beers, way less than the 100 beers that we have as a goal for this month's production. So as of right now, it looks like fermenting may be a bottleneck. Let's look at bottling as well, just to be sure that bottling isn't a worse bottleneck than fermenting is. Bottling takes 5 days per batch. So in a given month of 30 days, we can make 6 batches of beer, and 6 times 10 is a total of 60 beers. While we still can't reach our goal of 100 beers using our current bottling process, it still has a higher number of beers than our fermenting process. 60 compared to 15. So our bottleneck will always be the process that has the lowest number of product units it can create over this time period. So in this case, it's going to be fermenting. Fermenting allows us to only make 15 beers per month. While bottling doesn't let us hit our 100 beer goal, it is still significantly higher than 15 because it allows us to do 60 beers per month. Mixing is perfect. We can actually mix 100 beers over a month, which is exactly what we want to do. So mixing really isn't an issue whatsoever. This type of analysis allows companies to understand where they should invest their future money. You see, if I had some extra cash sitting on the side, I would say, oh, well, we should invest in our fermenting process and we should buy 4 times as many fermenters as we currently have in store just to be able to reach our total bottling capacity. So if we did that, we would have 4 times 15 beers per month, which is 60, exactly meeting our bottling capacity. And then at that stance, we'd have to decide, okay, are we going to invest in bottling or fermenting in order for us to increase up closer to that 100 bottles of beer per month goal that we have and we're able to reach with mixing? Does that make sense? Let's take a step back really fast. We found out pretty fast that fermenting was going to be our bottleneck. Remember, a bottleneck is just the process that allows you to make the least amount of product over a certain time period. Sometimes this is compared to what's called capacity. Capacity is the most amount of product you can make in a single process. So capacity for mixing was 100 beers per month. Capacity for fermenting was 15 beers per month, and capacity for bottling was 60 beers per month. The bottleneck is always going to be the process that has the lowest capacity, which is fermenting, as we figured out. So with all this information, what's the next step? Remember when I said our beer company makes 3 different types of beer? We see each beer sells for a different price. It also has different costs that go into making that beer, and therefore there's different things called throughput profit per beer. See, this throughput profit number is what's going to help us decide how much of each beer we should produce given our bottleneck. Throughput profit is calculated from sales price minus direct manufacturing costs. Remember, direct costs are things like direct labor, which is like man hours of actually sitting there fermenting the beer or mixing with our employees, things like that, and direct materials. That's things like the hops and the barley and the water that goes into making our beer. Those two, direct materials and direct labor, make up our direct manufacturing costs. So let's do some numbers to make an easy example here. Remember, we said we're gonna make 3 beers. Let's say that those are going to be light, dark, and fruity. Our light beer sells for $5 and has a direct cost of $2 per beer. So our throughput profit would be $3 per bottle. Our dark beer sells for $6 per bottle, but it has $5 in direct costs, so we only have $1 in throughput profit per bottle of dark beer. Fruity beer sells for $8, but only has direct costs of $4. So our throughput profit per fruity beer is $4. If each beer takes the exact same amount of time in each of the process steps, remember, mixing takes 3 days, fermenting takes 20 days, and bottling takes 5 days, then all we have to do is multiply our fermenting by the amount of profit we're going to get. So, if we're going to buy a new fermenting machine, how much would we be willing to spend on that fermenting machine? This is a complicated question, but it's easily solved. You see, all you have to do is multiply your throughput profit times how many more new beers you'll be able to make with that fermenting machine. So we know that each fermenting machine makes us 15 beers per month. So we multiply the throughput profit of our light, dark, and fruity beers times that 15 beers per month to figure out how much we'll be willing to invest into that machine. For example, light beer, we know we make $3 per beer in throughput profit. So 3 times 15 is $45 in new throughput profit per month if we use a new fermenting machine to make light beer. Dark beer, on the other hand, only has $1 in throughput profit per bottle. 1 times 15 is only $15 to invest into a new fermenting machine if it's used just for dark beer. Then fruity beer, we know that we make $4 of throughput profit per bottle. 4 times 15 is $60 in new profit per month that we can use to invest into machine. So, with those numbers in mind, if a fermenting machine costs us $50, which line should we add it to? Well, $50 is more than 15, so dark beer is out. $50 is more than $45, which is how much the light beer would make us if we added a new fermenting machine, so it's out. So the only one that really qualified would be fruity beers. So, that's only half the equation though. Can we sell 15 more fruity beers every month? Let's look in. Fruity is the only beer where we make more than $50 per month in new profit. So it's the only one that we should actually add the fermenting machine to. However, this automatically assumes that we can sell all of the 15 new fruity beers every month. Let's say that we can only sell a total of 20 beers of the fruity variety every month. That means that we're already making 15, and if we add a new machine, we can only sell 5 of those out of the 15 new ones we might be able to make. So those 5 extra beers times $4 in throughput profit per month gives us only $20, significantly less than the $50 per month that our new fermenting machine is going to cost us. So if we can only sell 20 fruity beers, we should not invest in a new fermenting machine. See, that's why it's very important for you to understand your demand for your product in order to be able to make the correct investment decisions when it comes down to your manufacturing and producing process. If you just assume you can sell everything you make, then you're just going to spend a lot of money on everything. But you have to understand that there are going to be constraints on the demand side and your production side. Taking those both into consideration, you might actually be able to make more money on the light beer process than you would on the fruity beer process because you can sell unlimited light beers. This is just all hypothetical, of course, but now you might have a better idea of how your understanding of the product, your production process, and the demand for your product can really help you make smart investment decisions and help you understand bottlenecks and where to invest your future dollars. Throughput analysis is all about maximizing your resources in order to make the most amount of sales and profit you possibly can. Remember, it takes into account things like bottlenecks and throughput profit, which is just the sales price minus direct costs. Now, with that under your belt, let's continue on to the managerial accounting and the next topic of interest, which is cost volume profit analysis.